Hello all, welcome back. Today we're gonna take a look at Square, or as its most recent name is, Block. It has been rebranded as that. So the company has fallen steeply, down about 43% last year. Yet in the last trading session it rose a little bit and got 10%, and currently trading at 128 almost dollars. Now we do want to examine the stock and see whether it's worthwhile potentially investing in it and how much we should be willing to spend for the stock. You will see that the forward PE of the company is sitting at 97.6 here, and the last 12-month PE pretty much is sitting at 387, potentially pointing to an insanely overvalued company. But let's start by taking a look at the financials and see whether that's actually the case. First things first, I'm going to take a look at the outstanding shares here. As you will see, the outstanding shares have been increasing a lot and steeply increasing in the last month or so, actually a couple of months before or so. So this is a bad sign because it used to be, the outstanding shares count used to be 300 million about, and now it's almost double that amount. So the company has been massively diluting investors, something which is terrible to see. I don't like that, of course. Short interest of 8% as well is worthwhile taking a look at, because that's relatively high, especially for a company of Blocks or Squares caliber. So let's take a little bit of a closer look at the financials of the company, see what they are doing there. So the income statement of the company is going to be the first thing that we're going to look at, and we're going to take it back to about 5 years. As you will see, the company has been enjoying some steep growth here, and that's probably the best thing about this company. They have been growing massively, and look at this growth in 2020, 2021. That's amazing. Now, I love growth, and I'm willing to pay a little bit more for growth, but I'm not gonna pay the company like 10 times its actual value just because they are growing. They will be growing into the future, because if I'm paying like 10 times more, then I'm actually prepaying for growth that has never happened, and I'm paying today what's going to be happening in like 10 years. And so will you be paying today, for a house that's going to be worth $100,000 in 10 years? Are you going to be paying it today? Of course not. You're going to be paying less than that because the current value is different. So this is important to understand, and we need to make sure that we're not paying more for an investment than what the investment actually yields for us. So the next thing that we're going to examine here is the net income of the company, which is actually much less than I would expect here. The company is a $74 billion company, and it's making profit of 166 million in the last year, basically. So that's not great, as you can understand. 74 billion is way more than 166 million dollars that they make in net income. So this points to an overvalued company, really. We'll see how much a little bit later. But the balance sheet of the company shows a company that is increasing its total assets, so that's good to see. And the total liabilities are sitting at $10.6 billion, while the total equity is sitting at $3.3 billion. So they have more liabilities than equity. And the cash flow of the company, as you will see here, the cash from operations is positive and keeps increasing. They had their steep increase in 2021, which is great to see for the company. And in terms of investing, they are at least investing a little bit in the markets. So I guess they're spending some of the money that they got from stockholders by issuing more shares back in the market. So here's a hedge fund for you if you're owning the company. So the cash from financing here is, so the company has been issuing quite some debt here, about more than 5 billion here in total debt the company has been issuing. Okay. And so, yeah, this is all positive again because of a lot of debt. That's not great, of course. The free cash flow, again, is fairly lower than you would expect, although 2021 is not terrible, of course. It's approaching $1 billion, but remember, it's not even $1 billion, and the company is $74 billion company in terms of its market cap. It's huge market cap here. So let's take an actual look at what we should be willing to pay for the company, just so that we understand when to buy, because that's important. So we're going to be using our stock evaluation tool and take a look at the financials. We have our handy table over here, and we have our handy averages over here too. And we do have some analyst projections as well, but I do prefer to use the averages that the company makes for the most part. because that's closer to the truth, really. It's based on history. So the company has been enjoying, again, amazing growth, but I'm not going to be using these insanely high values, of course. I cannot do that. That would be way too optimistic. I will still be more optimistic than usual, though, because the company has proven itself. So I'm going to still go relatively high. I'm going to go 15, 20, and 25 here. This is pretty high. I wouldn't do that with most companies. But again, this company seems to be, reaching this kind of growth. And so I'm willing to give it a little bit of a higher multiple in terms of growth that I use for my projections. So the net income margin, which is the next thing, is a little bit of a concern here because it's very low, and also it's in the negative in some cases. Now lately it has been better, and so I'm gonna kind of use the average of these 3 years, I suppose, which we do have here handily. And so I'm gonna go, let's go 2, 3, and 4. So pretty much being in between this 3-year average here. The free cash flow margin, again, we're seeing some years where the company wasn't doing well, but lately they have been doing well. So the 3-year average is sitting at 216. I'm not gonna go that high. That is stupidly high. That's not gonna continue. So we're gonna go like 90, 95, and 100. And the annual return that I typically want to be making is 13%. That almost never changes unless we have a company which has much more risk than the usual. So I'm gonna be calculating here and see what I'm getting. And as you will see, we're getting that in our highest estimates here with a revenue growth of 25, a net income margin of 4, and a free cash flow margin of 100, which is fairly confident. We're getting the highest price to pay today, which would be $50, is what we should be willing to pay today for this kind of growth over the next 5 years. The current price, though, is 128 almost, so we're way off. And if we're going with a low estimates, which is what we would probably go with normally, I am getting a value of price stock of $15, 15.27. So I would actually, myself, I would probably buy somewhere in between these two values here, because I think these two projections make the most sense. And so I would be willing to buy at around $20 to $25 this company block. But at 128, it's insanely expensive. And so I'm avoiding this for now. Tell me if you own Block. Leave a comment below. What do you think about it? Do you prefer other competitors of Block? Maybe PayPal, for instance, would be another one. Let me know which one you think is a better deal, really. Write a comment below. And if you are not a subscriber, you may think about becoming one, because I'm making tons of video pretty much every day. And at some point I'm gonna be giving you access to this too. So it's really worth it to stay around. And please like the video as well, because that really helps bring the content to more people. And thank you for watching this one. In the meantime, take a look at the video that I made earlier yesterday, and it was about Alibaba. And we're kind of discussing what happened with the insane steep increase that Alibaba had in the last couple of sessions or so. So actually it was for the most part one session really, but it was a massive session. So thank you for watching this one. I'll see you soon. Bye bye.